Okay, how about now? Can everybody hear me now? How about now, people? Everybody hear me now? Anybody give me the thumbs up? Yay! Andre, yes, we've got there. Right. Let's start again. In that case, if people can hear me, let's start again. First of all, my absolute apologies for the technical problems. So please forgive me. Well, it's not me. It's technical issues. I don't know what happened there. So forgive me. So let me start over again. And thank you for everybody's patience. I appreciate it. So anyway, let me start off with saying either a good morning, good afternoon, good evening, or good night, depending where you are around the world. And welcome to tonight's webinar on the third episode, I think now, of my Discover series. My name is James Alexander, and tonight's episode is called Discover the Biggest Market in the World. And the reason why I do this episode is really because, yes, it's for beginners. Yes, it's basic. But I think so many people, when they start trading, they rush into the market without understanding the actual functions and the mechanics of the product they're actually trading. They get themselves wrapped up too much in, understanding technicals or expert advisors, sort of looking really for like the holy grail or the secret answer. So yeah, this is for beginners, but even for those who are trading already, I do suggest stick around because you learn a few things and get a basic understanding of what you're actually trading when it comes to Forex. Now, let's do a brief introduction on myself again. Like I say, my name is James Alexander. I'm the market analyst here at Banc. I have over 20 years experience in the financial service industry. Okay, I actually started out at the young age of 18 and I became an independent financial advisor in the UK. As you can tell, I'm a Brit, so please don't hold that against me. I specialized back then during mortgages, doing commercial mortgages and pensions. This is why my sort of like attitude to trading is very sort of like risk controlled. But anyway, I'm losing direction on that. But anyway, and then I went into obviously alternative investments before going into the online trading arena. I've traded myself for a prop company in Dubai, Dubai Gold and Commodity Exchange, where I actually specialized in gold trading. Before sort of moving into portfolio management and looking after VIPs, and then sort of falling into education. I'm indeed a published writer, and I've been published in several leading industry publications, including the likes of Financial Times, Advisor, Market Watch, The Street. Like any market analyst, I always have an opinion on things, and because of that, I'm a very avid market commentator. I'm very passionate about this industry and about the markets. So I hope to share some of that passion with you tonight. I'm also a well-known public speaker because I go around several places around the world, and I've spoken at a number of events, likes of Singapore, Dubai, the UK, and Germany, etc. South Africa more recently. Now, I am an educator, okay, but what makes me different from other educators out there is that not once do I ever refer to myself as an expert. The reason why I say that is because I don't believe an expert actually exists in this marketplace. Okay. So what I actually really hope with these sort of little webinars I do is that I will share with you my experience, my knowledge, and my know-how, and my mistakes, with the idea that you take it away with you and you learn from it and you build your own knowledge, your own foundation, and really find your own path. Okay. I'm not here to give you the secret answer. I'm not here to give you the golden goose. I'm here to help you understand a few things so that you can go away and actually work out if trading is indeed actually for you or not. And if indeed you can find your way, you have what it takes to be a trader. Okay, so this is what I'm here to do. Now, tonight's episode, like I say, is called Discover the Biggest Market in the World. And like I say, it is for beginners, but I find it useful for anybody who's even traded before to get back to basics and understand, really the mechanics of what they're trading. So first of all, we'll talk about what is Forex and what is the Forex market. Then we'll discuss what is a pip, because so many people don't actually understand what a pip is. Then we'll discuss what is leverage, so you have an understanding of what leverage is. Because a lot of people say, oh, leverage, and they don't actually get what it is. Then we'll talk about the different trading sessions. Then we'll talk about market jargon, because like every industry, trading has its own secret language, so to speak. So then we'll talk about market jargon. And we'll end off talking a little bit about battle between the bulls and the bears. And then, of course, at the end, the standard question and answer bit. So any questions you have related to this webinar or what I talk about, please hold it to the end. So what is the Forex market? Now, Forex, or FX, is actually abbreviation for the foreign exchange market. The Forex market, this is why this is called Discover the Biggest Market in the World. The Forex market is the biggest financial market in the world. Its average turnover is around about $5 trillion a day, okay, which is a huge amount, several times larger than, say, the stock markets, okay? So it's a massive market. It is indeed the biggest financial market. Now, the market itself consists of investment firms, central banks, commercial banks, hedge funds, retail brokers, and people like myself and yourself, like the individual investor, the individual speculator. Now, there are sort of like two levels in this massive market, okay? There's the interbank market, which is where the large banks, it's a Barclays, HSBC, etc., they trade currencies for hedging purposes and balancing accounts, okay? They actually sort of tend to buy in a physical amount. And there's the other market, and this is the market we fall into, okay, which is the OTC market, also known as over-the-counter market. Now, over-the-counter market, this is us guys, us gents and ladies, of course. We're individual speculators, okay, and we trade through brokers and online trading platforms. We don't purchase anything physical, okay, like the big banks do. What we do is we speculate on where the price could potentially go, okay? And the thing is, the reason why this is the biggest market, okay, is that it's not controlled by one single exchange. Like, for example, the London Stock Exchange or the New York Stock Exchange. They control, obviously, the stocks or shares they have trading on their exchange, the same as London does, or say maybe even Frankfurt, etc. But we don't. But the Forex market is not controlled by one single exchange, so it's not controlled by anybody. So the Forex market itself, especially when it concerns us, our speculators, okay, is traded in pairs. All right. For example, you have the euro dollar, the British pound US dollar, and the dollar Japanese yen, just to name just a few. Okay. Now, when we trade, or when we speculate, we're speculating basically on the value of one currency against the other currency. So say we're trading the euro against the dollar, we will speculate on whether the euro is going to go up in value against the dollar or down in value against the dollar. And like I say, if we get the direction right, then we have the potential to have a profitable trade. But the flip side of that, of course, if we get the direction wrong, we then have a potential to have a losing trade. Now, when you're trading, you see obviously the market rates. You will see the bid and the ask. What does that mean, James? Well, here's my example, okay? This is a euro dollar, just as an example. We have the ask, which is the price the euro is being sold at. Again, you've lost the sound again. Okay, can everybody else hear me? Have we lost the sound again? Can everybody else hear me okay? Oh, Andre, you can hear me okay, yes? Christoffel, can you hear me? Can everybody else hear me okay? Andre, brilliant. I know Andre can. Okay, can everybody else? I can. Brilliant. So, okay, you can hear me. Okay, thank you, guys. Thank you for letting me know, because what Christoffel was saying that you couldn't hear. Anyway, all right. So, sorry, let me, sorry, we're obviously clearly having technical issues, so do forgive me. But anyway, let's crack on. The show must go on, as they say. So anyway, when you're looking to trade, you'll see two different rates. Okay, you'll see the ask rate. I said ask, and you'll see the bid rate. Okay, now the ask rate is the price that the euro is being sold off against the US dollar, and the bid is the buy price. You would buy the euro against the dollar. Okay, and the difference between the two prices is what you call the spread, which is the commission you pay to the broker. Now, the idea is that if you believed that the euro was going down against the dollar, you would sell it. And if you got the direction right, then potentially you have the opportunity to have a winning trade. If you believed the euro was going up against the US dollar in value, then you would buy it. And if indeed you got the direction correct, then potentially, indeed, you have the potential of having a winning trade. Now, what makes a difference between potential profit and loss, okay, is the movement of what they call a pip. A pip stands for percentage in point. It is a unit of measurement to calculate the change in value of one currency against the other. Now, most currency pairs, the pip is the fourth decimal point, exception being the likes of the dollar yen, where it's like the second decimal point. Okay, and gold is the same. Okay. Now, why pip is important is that the pip is what potentially makes your trade a winning or a losing trade, that pip movement. Okay, so we have a look at my example here. The fourth decimal point is the pip. That is what we're focusing on. That movement, or that fourth decimal point, is what we are looking at and what we are monitoring. Now, if you go back to my one example here, go back to this example. Now, look here on the sell price, I have written down 1.16895. Okay. If I go to my next slide, it then has 1.1688, which basically means that's down 1 pip. So that's 1 pip down. Now, it's the pip which can potentially make us money on its movement or lose us money on its movement. And this is how you understand how to calculate it, because at the end of the day, it's the pip's movements up or down which will make us the money or not. And that's what we all want to look at. And that's what we all want to try and understand, obviously. Now, there's two major factors to bring into account when you're calculating how much value that pip has. And this is one of the ways, and there's another part of this which we'll go through again as well. So we keep with the euro dollar because, like I say, it's the most traded currency pair. So say, going on that example, my first slide I had 1.1689. Then the next slide I showed you an illustration of it going down 1 pip. Say we sold it at 1.1688. We are trading a standard lot, which is a 100,000 contract. So to calculate the value of that pip, because remember it's the fourth decimal point, we'll go 0.0001 divided by the rate we sold it at 1.1688. That equals 0.000855578. That's a lot of numbers, James. I know. Bear with me. We take that number, 0.000855578. We times it by the contract size. In this case, we're talking about one lot, which is 100,000. Times it by 100,000. That gives us a value of €8.56. Translate that into dollars is $10. So that pip down is worth $10. Okay. So this is one part of how to calculate the value of the pip. That one pip down is $10. Had it moved $5 and we shorted it and we're selling it, that $5, obviously 5 times $10, which means $50. Okay. Alternatively, is it gone against us? That also means $50 loss as well. So let's do another example. Okay. Euro dollar again. Sold at 1.1688. This time we trade a smaller contract size of say 50,000, which is half a lot. So again, same calculation, 0.0001, the fourth decimal point, divided by 1.1688 equals that long, great big number, James, 0.000855578. Sounds like a telephone number. This time we times it by the smaller contract size of 50,000 equals half of the 100,000, which of course is €4.27, which means this case, the pip is then valued at only $5. So one aspect of what makes value of that pip, and we need to know what that pip value is because that makes a difference to how much we can potentially make or potentially lose, is contract size. Understanding the contract size. 100,000 based on with leverage, which I'm going to go over next, $10 a lot, half a lot, 50,000, 1 to 100 leverage equals $5 a pip. And this brings us to the other really huge factor, which so many people, again, don't really understand what they're doing or what they're using it with. And leverage is the other thing which has a major factor in whether or not that what that pip is valued at. But what is leverage, James? I will tell you what leverage is. And I would tell you what leverage is by telling you a little story. So you have $20,000 and you want to purchase a property for $100,000 because you see it's a good opportunity and you see that potentially in the future it could go up in value. You only have $20,000 though. So to get the other amount you need to buy that property, you go to the bank and you borrow $80,000, which combined with your $20,000 means you then buy that property worth $100,000. That $20,000 has given you control of something worth $100,000 Because it's giving you the leverage of 5 to 1. 20,000 goes into 100,000 5 times. So 20,000 has given you the control of something of 5 to 1 leverage. Now, 1 year later, property prices have risen by 50%. So that property you bought for 100,000 is now worth 150,000. You sell the property, giving back the 80,000 to the bank which you borrowed, and taking back your 20,000 along with your $50,000 profit. That 5 to 1 leverage has meant your 20,000 has given you the opportunity to make $50,000 profit. Let me tell you the flip side to this story. Instead of using leverage or borrowing money, you use your 20,000 to purchase like a studio apartment for like 20,000, which is 1 to 1 leverage. So 20,000 goes into 20,000 once. So there's no use of real leverage at all. Same thing happens. Property prices go up by 50%. And now that property is worth 30,000. You sell for 30,000, taking back your 20,000 initial investment, and with it, that $10,000 profit. Using 1 to 1 leverage, you have made a smaller profit of only 10,000. You see? So this is what leverage is about. Okay? Leverage is about giving you more of a room to obviously potentially make more profit on the capital you invest. Flip side of the coin, of course, leverage also potentially means you can lose more at the same time. Because the higher the leverage, the more potential profit you have, but at the same time, the higher the leverage, the more potential loss you could potentially have as well. It's a double-edged sword. So let's bring this into contents into Forex trading. Again, this, along with contract size, has a big impact on what that pip is valued. So you invest $1,000 into the market. Again, we keep with the euro dollar. You short the euro dollar at 1.1688. The lot size, standard lot, 100,000. 1,000 into 100,000 goes into 100 times, which means you're using 1 to 100 leverage. We've done the calculation previously, so that pip is valued at 0.00008555578 times 100,000 times the contract size equals that pip value of €8.56, which is the 1 to 100 leverage, which is $10. You have a 10 pip movement, which means that's potentially $100 profit if you got the direction right. If you got the direction wrong, then potentially, of course, that's $100 loss. Do another example. This time, you invest $2,000 into the market. Your euro dollar, again, we sell it at 1.1688. Lot size, keep to the lot size of 100,000. So we're not changing our contract size, but we're changing the leverage because, obviously 2,000 goes into 100,000 50 times. So this time our leverage is 1 to 50. We know the pip value already potentially at 100,000, but at 1 to 100 leverage is €8.56. At 1 to 5, that pip value is now only €4.27, which equals $5, which means, of course, a 10 pip movement is $50 using smaller leverage. So that's a potential $50 profit, but on the flip side, if it's gone against you, that's also a $50 loss only. So you see, leverage and contract size both has a massive impact on what that pip, which is all about the pips. It's all about how many pips moves this way, how many pips we catch here, has a big impact on our potential profit, but that's at the same time our potential loss. Now, as I mentioned at the very beginning, this is the biggest market in the world. Sorry, my throat's getting a little dry. And because it's the biggest market in the world and there's no central exchange, it actually is a market which trades 24 hours a day, Monday to Friday. Monday to Friday. Okay. Now, the actual Forex market itself, it actually opens about 6 a.m. Sydney time and closes at 5 p.m. New York time on a Friday. So it's 24 hours, 5 days a week. Which means, because it's 24 hours, we're not all awake 24 hours, it's actually split into 3 main trading sessions. Now, the first one is the Asian session. Okay, this is the Sydney and Tokyo. Like I say, it opens on a Monday, it starts it off, but it actually opens around 6 a.m. Sydney time and closes at 5 p.m. Sydney time, so 11 p.m. to 8 p.m. GMT. Okay. Now, because it's the Asian session, it likes countries like Japan, Australia, New Zealand. Of all the 3 major sessions, this is the smallest session. Okay, in terms of trading volumes. And like I say, it really consists of countries like or cities like Sydney, Tokyo, and Singapore, the main financial capitals in the Asian market. Because it's focused mainly on these countries, the most liquid currencies during this time, which will make sense because those are cities which are awake, would be like the Australian dollar, the New Zealand dollar, and the Japanese yen. Then, the next session after that is the European session, or basically, realistically, London. Okay? Now, London opens around about 8 a.m. GMT and closes at 4 p.m. GMT. So it opens at the same time where the Asian session is slowly winding down. Now, this is the biggest trading session. Okay? And it makes up nearly 50% of the total trading volumes, and it's extremely liquid. What I mean by that is extremely volatile, potentially extremely volatile and very fast moving, because you have the real big guns playing during this session. Countries involved clearly during this session are European nations, obviously. So it's London, Paris, Frankfurt, and Zurich. And because it's those countries and those capitals which are playing in the market at the time, the currencies really to watch during this session includes the likes of the euro, the British pound, and the Swiss franc, for example. The final session is the North American session, basically New York. And this opens at 8 a.m. and closes at 5 p.m. New York time. So that's around about 1 p.m. to 10 p.m. GMT time. It is the second biggest trading session in terms of volume, so it's highly liquid. And so the main cities really sort of trading in this session includes the likes of New York, Chicago, and Toronto. Currencies clearly to watch, though obviously all the major pairs are still being traded, of course. But the main players to watch during this time is obviously the dollar and the Canadian dollar, the loonie. Now, here's the thing. Because it opens round about, like I say, the 1 p.m. GMT, it crosses over with the European session, which means you have the biggest session opening and trading at the same time as the second biggest session, which means potentially the market can be extremely volatile during this time. However, after Europe closes, the last couple of hours of the US session, liquidity starts to dry up. So it starts to get quieter and it starts to slow down. Now, actually, if I just go back, the reason why I talk about sessions is A, to open your mind to the fact that, like I say, this market is 24 hours a day, Monday to Friday. And the reason why I go over these sessions is, like I say, with trading is individual. And it's about finding your way and finding your own path. So depending on your attitude to risk, Obviously, trading in general is risky, okay? But like I say, if you're less risk averse, then maybe you might want to focus on a less liquid session, less fast moving session, which is the Asian market. If you're high risk, then obviously the European and so the European crossover with the US session or North American session might be the session you might want to trade. So this is why I discussed the sessions. A, to underline the fact this market is 24 hours, Monday to Friday, plus to also pick out what session may fit your trading needs or your way or your trading style. Now, market jargon. Now, all industries, like I say, medical profession, any profession, they all have their own, excuse me, their own secret word or code word, etc., whatever they want to say, okay? And the Forex market or the trading market is no different. We have words which we chuck in and we use, which unless you understand what those words actually mean, might actually get quite confusing. First of all, I've said this already, and you might hear other people say it. When people say go short or shorting, what this basically means is sell. I'm selling. So I believe something's going to go down in value. So I'm selling. Short, shorting equals sell or selling. Go long or I'm long. Basically, that means the opposite of shorting. I'm buying or I buy or an asset because I believe that asset going up in value. Squaring up. Basically, that means closing your positions. The market is crashing. The market is selling heavily. The market is rallying. Means the market is buying, so obviously the prices are moving up. Opening bell, when the market opens. Closing bell, surprise, surprise, the market is closing. See, some of these are quite simple, but still. A fat finger. This is when you see a sudden market activity caused by a mistake made by a trader, i.e. some young whippersnapper, some young trader has accidentally, instead of selling 1 million contracts, he's accidentally put 100 million in by accident, has caused the market to crash. That's called a fat finger. Flash crash, similar, but this is when you see a crash in prices caused by a computerized system, like a fault in an expert advisor or a black box solution, which then spikes the market down or up, usually down. That's a flash crash. Prime example, what happened back in 2016, October time, when the British pound spiked down as low as 1.16. That was back on electronic trading program, selling heavily by mistake. Limit order. This is an order to buy or sell an asset at a fixed price. So something you set the system to buy an asset at a designated price, and it will do that automatically if that price is actually indeed reached. Cable. This is the nickname for the British pound, US dollar. Loonie, one of my favorites. This is the nickname for the US dollar, Canadian dollar. Greenback or buck. This is the nickname for, surprisingly, the dollar. Kiwi, which is a nickname for the New Zealand dollar. Aussie, have a guess what nickname that is for. There, of course you know what it is. It's a nickname for the Australian dollar, obviously. They're very imaginative and creative, these names. The cable's actually quite creative, and Loonie is, but and the greenback is, but the Kiwi, Aussie, not really. Yellow metal. Anybody have a guess what the nickname for that is? Or what that means? Type me. Any guesses? No? It's gold. I'm a big fan of gold. I trade gold a lot, so I know gold quite well. So yes, it's called the yellow metal. The Swissy, everybody knows what this is, obviously. It's, of course, the Swiss franc. So there's some of the jargon for some of the currencies. There's a lot of animals talked about in the market as well. A lot of animals talked about in the market, or mentioned them animal names. Hawkish. This basically means when a statement is made by some, like, I don't know, say a governor of a central bank who is aggressive or hints that they may do increase interest rates or may be active in doing monetary policy, because they're aggressive in their statement, they're confident, they're called hawkish, because obviously a hawk is a predatory bird. Dovish, this is if a statement is made which hints at a possible rate decrease, or someone's a bit nervous about the state of the economy. I'm talking about heads of central banks here, or economists. They're dovish, means they're nervous about where the economy is going, so they may not do anything, or they're dropping hints. They may decrease interest rates. Dovish is obviously an innocent sweet bird, so that's why it's called that. A dead cat bounce. This basically means when an asset has been falling and then suddenly jumps up before falling again. Bulls and bullish, and this is what's important. Bulls, these are individuals who believes an asset will rise in value. So say, for example, I'm not, but just give you an example. Say, for example, I was a bullish on gold, and say I'm a gold bull. I believe gold is going up in value. I don't. I'm just giving you the example. Or say I believe the pound is going up against the dollar. I say I'm bullish on the British pound. I'm bullish because I believe it's going to go up. I'm not, again, but again, this is an example. Then you have the bear or bearish. These are the opposite. Okay, these believe the asset will fall in value. So say, for example, I would say, again, I'm not, but say, for example, I'm bearish on, say, the euro, because I believe the euro is going to fall. I don't, but I'm just giving that as an example. Or I'm a silver bear. I believe silver prices are going to fall. So bear and bullish means they believe, or groups of people who believe something's going to fall in value. And this really is the cruncher, because it's really the battle between these two. How many bulls are in the market and dominating, and how many bears are in the market and dominating? If there's more bulls, then obviously they're bullish, they're pushing prices up. If there's more bears, they're going to be scared and bearish, they're pushing prices down. So this is where you hear, like we have with the stock market at the moment, the bull market, because the market is rising. The opposite to that, of course, is a bear market when the market is falling. So it's a battle between these two groups of people, the bulls and the bears, how many there is, or how more of them there is than the other in the marketplace. So yeah, there's a brief introduction to the biggest market in the world. Let's say the episode 4 of my Discover series. So I lead up to now. Any questions anybody likes to ask me about this webinar at all? And if I know the answer, I will certainly answer it for you. Any questions at all? Anyone? Did it at least make sense? Or did anybody at least find it interesting? Or is everybody sick of my voice by now? They're sick of me. They want to go home. They've done enough of listening to me. Okay. Despite the technical problems, did everybody at least enjoy it or find it useful? Thank you, Christoffel. Oh, brilliant. I'm glad you find it simple enough to understand, because that's the idea, my friend. This is what I like to try and do. I try and, instead of like making it overly complicated and jazzing it up and giving, false ideas, I like to try to make it quite simple and easy to follow. Thank you, Jeff. Very interesting. Brilliant. I'm pleased you found it interesting and good. Thank you. I like that. What I will ask as well, ladies and gents, obviously, look, the Discover series I write it for your benefit, to help you, to help you understand bit more about trading, a bit about the market, but also understand at the same time if trading is indeed for you or you have what it takes to be a trader. With that in mind, I always ask this every session, is there any topics or any other areas you like me to maybe do a webinar episode on or a video on? Any suggestions, any things you'd like me to cover, please let me know. And I'll be more than happy to write something for you and obviously then broadcast it to everybody. So please let me know if there's anything in particular you're interested in or you like me to cover. Maybe it could be a case study on gold, or maybe it could be a case study, or I'm doing one on Elliott waves very soon. It could be more technical based. James, tell me about the moving average crossover, how that works. Could even be one about stocks, what sort of stuff to look in for stocks. Anything at all, just let me know, and I'd be more than happy, obviously, to do something for you on that. So if any topics like that, please do not hesitate to let me know and contact me. Is there any other questions or anything at all anybody would like to ask me? How about those November midterm elections in November, guys? For the US, that's going to be interesting, isn't it? I'm going to enjoy that. That's going to potentially have an impact on the market. Frederick, about Forex. Yes, sir. What would you like to know about Forex? Oh, no questions. Okay, Frederick. But you want me to do another one more on Forex and currency pairs, yeah? Maybe? Okay. Okay, if there's no other sort of questions or anything like that at all, or no topic ideas, nobody would like to say any topics, can I first of all really thank all of you for coming tonight and spending my time with me tonight. I hope I didn't get too boring for you or too overpowering. Can I give you a special shout out to Andre, Christoffel, Aldis, Ancor, I hope I said the name right, Jeff, and Frederick, and of course every single one of you who joined me tonight. A big thank you for joining along, but special a shout out to Frederick, Jeff, Christoffel, Ancor, Andre for being interactive and asking me questions. I love it when you're interactive and ask me questions, because otherwise I get quite lonely talking to myself. So it's nice to have interaction. But thank you, guys. But indeed, thank you. Oh, I've got some questions. Hey, all right. 2 great questions before I go. I love it. Brilliant. Christoffel, do you see anything in the next day's movement when looking at the last minutes before New York closing? Okay, right. That's a very good question, actually, Christoffel. Now, as I mentioned in the US session, and Frederick, I'll answer your question in a second. That's brilliant. Yeah, what you tend to see, okay, in the US session, because it gets quite liquid, or not so liquid, it's quieter, especially maybe on a Friday, is the market about to close for the weekend. Sometimes you can see like stop loss hunts where maybe some of the big banks are, trying to take other players out. So it can be very, very tight. And then you see something big drop off before it then goes up again to where it was. You can see stop hunts happen in the last minutes of the New York close. And what you tend to see, because the Asian session the next day is not as big as obviously the European session or the US session, you often see the Asian market continue, okay? But the same direction, because it's not big enough to change it around. But you can obviously, like I say, you tend to see maybe a big spike down at the end, just as people get a little bit, tired because the market's in liquid. But that's what you do see. But a great question. And Frederick, how to trade Forex with different orders like stop loss, trading stops, and so on. Great question. Okay. Now, first things first, I'm a big fan of people using stop losses and take profits and indeed trading stops. Let me tell you the difference between the three, okay? Take profit, okay, is the level you set on your trade that if it reaches a certain level and it's in your favor, it will close a position automatically, locking in that potential profit. Okay, so it's like, just in case you have to go to the shops or something, so you're not there to watch it, you set it straight away. So if it does hit it, it'll close your position, locking in profit. The stop loss is the opposite. It acts as a safety net. So it's a level you set that if the market falls or goes against you, it will hit a certain level you programmed the trade to close at, and if it hits that, it will close that, making sure that you don't lose more than you're willing to lose on that trade. So stop loss of protection. A take profit is to obviously close it when you're in potential profit. And I really seriously recommend always using both. A trailing stop is different. It's like a take profit. Whereas a take profit you set is always set at that level, okay, no matter what you do. A trailing stop, again, is a take profit order, but what will happen if the market moves up, it moves up with it. So say I set my trading stop at 10 pips above a certain rate, and it goes past that rate and it moves another 10, it moves it up. Okay, so if it comes back down, it will close, locking in my profit or protecting my losses. So let me explain that a little bit more easier. Okay, all right. Okay, say I've gone long on the British pound against the dollar. Okay, I buy it at say 1.1320. Okay, I'm going long on it. It goes to 1.325. Okay, I set myself a trading stop, which means I'm in profit now because I put it 130.10. Okay, and it's at 130.25. I set my trading stop to 10. So if the market carries on going up, I will keep making more profit. However, if the market spikes down, it will close, because I said it was at 130.25, it will close at 130.15, okay, locking in a little bit of profit. If it doesn't, it will carry going on and up, and my trading stop will keep moving up and up and up, moving another 10 pips, another 10 pips, locking in more profit. But in case the market spikes down against me, it locks in that profit and also protects me. So trading stop is like a moving take profit. It moves with the market for you when the market's in your favor. Great question though, Frederick. Brilliant question. Any other questions before I go? But Christoffel and Frederick, fantastic questions. Thank you for that. Really good questions. In that case, in general, what percentage do you take to set up a stop loss and take profit, please? Okay, interesting question, Frederick. Okay, look, there is no wrong or right answer to what percentage do you take to set up a stop loss and take profit. Okay, there's no wrong or right answer. It really depends, okay, on A, your risk management strategy, okay, and your trading strategy. Okay. By the way, just so you know, I am going to be doing a special webinar on that, on risk management and trading strategies for you to help you develop it. Now, I can't tell you the right way or the wrong way, okay? But what I will say, some people, okay, they trade 3 to 1, okay? So say, for example, their stop loss is at $50, but their take profit is at $150. That's 3 to 1. Other people trade 2 to 1. You know, that's the way, that's how they do it. So there's no wrong or right answer. It all depends on A, your risk management, what you've got playing at risk, and B, what your trading strategy is. Okay, there's no secret way. But I say a lot of people tend to look at 1 to 3 or 3 to 1 profit to loss ratio, or maybe 2 to 1. Okay, but if this is something you want to look at, Frederick, what I seriously suggest is make sure you come to the risk management. And the email will be going out, letting you know when I do that one and when that one's available. But come along to that, because hopefully you'll find that useful. But again, a very good question. In that case, if there's no other questions, again, shout out to everybody here who's attended, especially Christoffel and Frederick at the end. Brilliant questions, my friends. Thank you so much. Good. Well, look, Frederick, please come to me. Come to the next one. All right. I'll be going over lots of strategies and things like that to help you. I'll let you know when it is, but it is a good one. And I'm a big believer in risk management and trading strategy, because at the end of the day, trading, you're going to lose. So the best way of trying to succeed is controlling your losses. So if you've got that risk management in place, then you have a better chance of building a portfolio, because you're going to lose some trades. That's the idea. That's the fact. There is no 100% winning. Forget that. Doesn't happen. Not going to happen. So you need to understand how to control your risk to build your portfolio. But brilliant, come to that. But anyway, ladies and gents, once again, thank you so much for coming. Shout out to Christoffel, Frederick, Jeff, Andre, etc. Thank you so much, especially Christoffel and Frederick at the end, asking brilliant questions. I really appreciate that. Till next time, can I wish every single one of you either a good morning, good afternoon, or even a good evening, or even a good night. Frederick, you're welcome. Please come to the next one. Or even a good night, depending where you are around the world. Till next time, can I wish you, everyone, a fantastic day, and all of you, trade safe.